interest rates in the Federal Reserve and kind of the state of that. So I have a graph here. It shows interest rates and the years going out. So 2020, 2021, and the start of 2022, you have these 0% interest rates. They started to quickly raise interest rates, and right now we're somewhere right here. So this graph is a little off. It's a little off, but you're raising rates, and then they'll probably taper off here somewhere. Maybe a little less than that, but somewhere around there. The graph would look something like that. So what does that mean for the bond investor? Well, it means that if you bought a bunch of bonds right here, and rates were close to 0%, and you see this huge spike in interest rates, well, what happens is bond prices have to collapse. And that's what you're seeing. I mean, bond prices have fallen over 40%, well over 40%, depending on where you look. So what is the Federal Reserve really doing? They're really over pushing it. They're pushing it too far. They're pushing the rates way too far up, and they're going to push them way too far down. That's what I believe. I think that you'll see inflation turn to deflation very quickly if you keep up these rate raises and you increase them drastically like they've been doing. They want to see higher levels of unemployment to cool inflation down, which is understandable. But I mean, you're going to start to see recession signs start to flash more and more as interest rates climb. We know inflation isn't going to stay that high. I mean, the Fed funds rate is like 4.75%, almost 5% right now, which is very high, and it's only going to be going higher. If you end up at that 6-7% mark, that's crazy, and it will cause a recession, in my opinion. I think they're going way too far. So how do you capitalize on that? Well, I think you're going to see a very big increase in bond prices once you see this interest rates tapering off and you start to see the decline. That's where you would make a lot of money on the decline. When interest rates start to decline again, you start to see recession. You see a recession, bond prices are going to go up. They're going to go way up because they're going to be forced to lower the rates. Those raises are going to turn to decreases real quick. So if you were to invest $10,000 in bonds close to that peak, I don't know where that peak is. Maybe it's Q3, Q4, 2023. If you do that, and you see a big increase in bond prices, you're going to see maybe 60% return on a bond. So if you had $10,000 in bonds that turned to $16,000, just like that $10,000 would turn into $6,000 here, from that, you're going to get a very big return on the decline. If you were to buy that same $10,000 worth of a bond, you'd get $16,000 there. Just an estimate, a guesstimate there. So if you were to do that, that'd be a great way to capitalize on it. Also, if you just bought a bunch of call options, obviously a little bit more risky, but I think that especially once you see that deflationary signs, if we do get to that point, I'm not saying we will, but if we do, then there's going to be a lot of rate raises coming down. And once inflation really gets down to that 2% mark, and if you see it drop, they're going to be raising rates very fast. So if you were to buy, a $10,000, an option that controlled $10,000 worth of bonds for $700, you're going to get that same $6,000 return, but on that $700 investment. Now, obviously, it's more risky because you could lose that entire $700 investment if it doesn't play out. But that's an 800% return if it does. So for example, if you were to buy a $4,000 worth of calls, you would make that $4,000 would turn to $36,000 if that scenario were to play out. I think that's the state of the Federal Reserve right now. I think they're pushing it up way too far, but I think it is going to provide a good opportunity for the person who kind of understands what's going on.